Now, today the Dow was able to erase 100 points off the bottom. It closed about 80 points lower than the worst-case scenario. So is this another February 11th-like turn? More compelling also, guys, gold giving up almost all of its gains, and the fear index, the VIX, closing down for the session. Treasury yields, however, still very much lower, but there are some signs that we could be oversold here, and maybe the bounce happens tomorrow. Joining me now to discuss, Chad Morganlander. Are you buying? Have you been buying the last couple sessions?
Very light, quite lightly, I would say. In fact, I wouldn't be surprised to see an additional perhaps 4 to 8% downside risk within the S&P 500. And that's based, by the way, Charles, on global growth deceleration as well as earnings being so, let's just say, stuck in the mud.
Is this growth deceleration with respect to all the, because of the British exit vote?
It's a combination. It started in China with the emerging markets, and we expect an additional perhaps deceleration. So let me give you an example. Instead of global growth being 3.4%, that's where the IMF has it, we're close to around 2% for 2016. And we're not going to see a real big bounce in 2017.
A double-digit decline. I mean, do we start to get into some real serious, or just something a little bit more subtle than that's what you're looking for?
I just think that there's going to be a continuation of a valuation deterioration. We're not expecting an additional 3% downside risk for tomorrow or the next day, but you could see 0.5% to 1%. Look, multiples are somewhat extended. We're looking at a PE multiple of 17 times forward-looking with very little earnings and revenue growth. So you just want to be more pragmatic, a little bit more cautious.
But historically, when markets fall apart, the PE ratios, the multiples are a lot higher than that. I mean, usually they're in the low to mid-20s.
Well, exactly, but you haven't seen earnings actually fall yet, and that's the big difference. When that happens, you actually see a decline within earnings of 20 to 30%. You haven't had that happen yet, so that's, I believe, perhaps the next leg to drop. But we're not expecting, again, a real terrible decline within the overall market.
The average person watching, I've had more people who are either in the market, just, you know, regular individual investors say they want to buy this dip than ever before. Right. Is that the ultimate contrarian move, you know?
Not yet.
Or does it mean that people have learned lessons from the past?
I think that you have to wait a little longer. Perhaps you get that 8% sell-off, and then if you're a long-term investor, meaning you have 3 to 5 year type of time horizon, then you should be buying. Hey, our expectation is still for a positive return over the next 5 to 7 years of roughly 5 to 6%.
You buy defensive stuff, companies located mostly in America, like the Cloroxes of the world, or do you actually buy the stocks outside of the world, in the outside world, that may be oversold?
For our portfolios, we're overweight U.S. dollar denominated. We're overweight bonds. We have some gold in the portfolio, and you want to just stay with the steady eddies. The rising dividend stocks, the biggest in the blue chip.